All right. Hey, everybody. Welcome to another episode of the Investor Frame podcast. I'm your host, Paul Sparks. And on this show, we ask real estate investors and entrepreneurs to share their story so we can all learn from their experiences and get closer to the things that we want in life. Today, I'm here with a new friend, Tyler Vinsand. He's someone I've met through Collective Genius. When I met Tyler the first time, he had won a belt at CG, and he was presenting on his creative finance strategies where he does seller finance. Tyler comes from a pretty technical background. He's got a master's in accounting. He worked for one of the big four companies, and then just realized, like, this ain't it. I need to figure out how to get closer to what I actually want. So I'm extremely excited to have him here to share his story. He's acquired over 70 rental units, majority of which he's bought with no money down on creative finance strategies. So looking forward to having him share his story, and welcome in, Tyler. It's great to have you.
Thanks, Paul. Awesome to be here. Yeah, really looking forward to this.
Awesome, man. Well, let's kick it off with a 6-word update. And for those who aren't familiar with this is a way to get our guests to share what's on their minds in terms of either their personal life, their business, or their investments in 6 words or less. So, Tyler, what is your 6-word update today?
Measure the gain, not the gap. So we're in obviously in a tough market here. Business is slowed, I think, across the board for a lot of people. I know we're feeling it, but like a lot of like-minded entrepreneurs, right? We have these big goals, and we run into these rough patches where maybe we feel like we're set back, and it's easy to measure that gap between where we are today and where we want to be. Ultimately, it just creates a lot of stress. But taking a look back and measuring the gain from where we were a year ago, 2 years ago, 5 years ago, right, produces a lot of gratitude and just a lot more happiness. So that's what's been going on in my world more now than ever before.
That's great. We heard Jimmy Vreeland speak on that last time we were both at CG, and I think it was in October. Is that a Ben Hardy book?
Yeah.
That's right.
Ben Hardy,
right.
Dan Sullivan. Yeah.
No, it's great. I've got it on my shelf. I've thumbed through it a little bit. I need to pick that one up. But, well, tell me a little bit about your background, because I think you have a lot in common with the people that are listening to this. There's a lot of folks who have done well for themselves. They, this very predictable path, right? We go to college, then you get a master's degree, and then it's like you've got your life sort of laid out for you. So talk to me about that. Talk to me about that process of when you realize, I don't know if this is something I can do for the rest of my life.
Yeah, I was raised super traditionally, and no slight to my parents. I love them to death, and I had a phenomenal upbringing. But I was raised, get good grades in school, and there was so much pressure put on that, right? Like you had to get the 4.0, because if you didn't get the 4.0, then you're not going to a great school. If you're not going to a great college, then you're not getting a great job, right? So that's how I came up. Getting good grades in high school meant everything. Going to a good college meant everything. So I went to the College of William and Mary. The buck didn't stop there, so I had to continue to push myself to get phenomenal grades. Ultimately, and then I went on to grad school there, landed a job as an auditor at a big four accounting firm, and I went on to get my CPA license as well. And at that point, it's like, man, I did all this work, like everything is set, like it just like I was supposed to do. Well, I'd say like a year into the job, man, is when I discovered real estate investing, and it almost spoke like exactly what I was feeling in my soul, like hearing about financial freedom and hearing that the results that you attain are in direct proportion of the effort you put out and the things that you learn, right? So my biggest issue in the corporate world that I had anyway was I felt like there was a glass ceiling over my head. No matter how hard I worked, no matter how much I learned, like, yes, there's promotions there, but it didn't grow in proportion to the work that I was putting in. So what I did at that time is every single day before work, I'd get up at 4:30 and I was listening to podcasts. I was reading books, going to the gym, and I've got bigger pockets in my earbuds playing all the time. I get off work, my commute home, I'm listening to podcasts, audiobooks, and staying up late, reading books and building relationships as well. Finally, this was probably a year and a half into starting my accounting career. I met at the time, he was a 19-year-old wholesaling here in Virginia Beach. And he was like making a killing. One of my buddies from college told me about him, and he was like, man, do you remember Will? And I was like, yeah. He was like, dude, he's killing it. Like right there in Virginia Beach where you are in real estate. So I messaged him and, met up with him, and this was in November. So for those of you who aren't familiar with auditing, right, I audited a large public company. So from January 1st, like basically when the books closed, till financial statements are issued, which was like February, and then another client through April, we're working 80 to 100 hours a week. So I met him in November, kind of audited his books, and I saw it was legit. And I told him, I said, look, let me get through this busy season. As soon as I get through, I'll put in my 2 weeks on April 15th and I'll come work for you starting May 1st. And that's exactly what I did. And worked for him for a year. And then I started up my own operation from there.
Man. Well, what I love about what you did is, you built that side hustle while you were still working, right? You're learning, you're engaging. And at a certain point, it's like, okay, let's go for it. We've got enough background. At a certain point, you've got to go engage and take that first step. And so how did that transition go? And you did something that I think is hard for a lot of, visionaries, which is to go work for somebody else, right? So what was that process like?
There's a huge stigma. And I think it's almost even looked down upon to go work for somebody else, especially, not to toot my own horn or whatever, but right. I went through undergrad. I went through graduate school. I got my CPA license. I got this big fancy job and I got my CPA license, and I'm quitting and leaving all of it behind to go work for a 19-year-old with a startup that he had. Like, talk about, parents being disappointed, right? Like, I was the butt of all my friends' jokes. For me, it just didn't matter though. So I viewed it as I have two options, right? I can go work for this kid and help him hit his goals. That is what I ended up doing. I worked for him just as an acquisitions manager for about 8 months, and I did very well. Blew his goals out of the water for him. He ended up moving to California to start an artificial intelligence business and promoted me to COO of the business. And it went well for a few months, and he ultimately just decided, he's like, man, I think I'm robbing you of your potential. Like, I think you need to start your own thing. So he kind of kicked me out of it. But my other option was to try to just start on my own. And Paul, to be totally transparent, I didn't know the first thing about anything when it came to real estate investing and wholesaling. I read a lot of books. I talked to a lot of people, and that stuff is great, but I didn't have the guidance that I needed. So I think if I would have dove in head first and just started my own operation from the get-go, I think I probably would have been done after a month or two, to be honest with you.
Mm-hmm. Man, that reminds me of my first year in business, which is just like, you just get kicked in the shin left and right. And, because investing in real estate is very different than running a real estate investing business. Yes. These are two completely different things, buying deals versus I know a little bit about your business now, right? You've got lead managers and acquisitions managers and a dispo side, and you've got training and onboarding and all this stuff. And what you realize is that's completely different than just picking up some deals here and there, right? So tell me a little bit about what the business looks like today.
So today, it's pretty simple. All lead generation is almost exclusively SMS at this point. It's SMS and relationships, but the vast majority comes from SMS. That trickles down to a team of lead managers, which, for those of you who aren't familiar with how lead management works, they simply take what we call, just a gross lead or a lead, which is someone that raised their hand and expressed interest in selling, and we qualify them. We confirm the phone number is correct, confirm they have a property to sell, gather price, timeline, condition, motivation, any other decision makers, any roadblocks, set the appointment, and get them to commit to making a yes or no decision on that appointment. That's lead management's role. And then I've got 2 acquisition managers, and then I do a little bit of acquisitions myself as well now. And then I'm also based in Virginia Beach, Virginia. Mm-hmm. So that's what the wholesaling operation looks like. As you mentioned earlier, I have over 70 rental units that I own. And actually, we just locked up a pretty good one today, a 13 package deal, seller financed. Nice. Yeah. Seller financed, no down payment. Maybe we can unpack that one a little bit later, but yeah, so I've got a pretty good size rental portfolio too, that's split between Central Arkansas, so like the Little Rock MSA, and then my market here in Virginia.
That's great. And so one of the things that we talk a lot about on this show is the concept of the solvable problem. And one of the things that I think plagues entrepreneurs and business owners in general, real estate investors are not exempt from that, is this concept of just chasing more and more and more. It's an endless loop, as we know. And so a lot of us, we start acquiring rentals because we're using it for passive income and different things like this. And so I'd like for you to tell me a little bit more about how you think about your solvable problem and how your business and your rentals and all these things function to help you get closer to that.
Yeah. First off, I want to raise my hand and say I was absolutely guilty of the more, not necessarily closer, especially my first year or two in business. Absolutely. But so my solvable problem, Paul, is actually pretty similar to yours. So you mentioned that you want to play business as a sport, right? And I want my business, me working on and in the business to be an option, not an obligation. Ultimately, what that boils down to, I set out like a success criteria that I look at the beginning and end of every single day. Very first piece of this criteria that I look at is I can wake up every day and ask, what would I like to do today? Second piece of that is my passive income exceeds my lifestyle needs. So for me to not have to worry and to give my wife and I the lifestyle that we want, that boils down to about $20,000 a month in passive income. Third piece of the criteria is that I can live anywhere in the world that I choose. So we're actually in the process of listing our primary residence right now, and we're going to be living like a nomad life, hopping from furnished rental to furnished rental in different cities around the country. The fourth piece of my criteria is that I want to work on projects that excite me. I don't want to be working on projects that drain me or I don't get a lot out of. I can disappear for several months with no effect on my income. I don't want to have to be called upon for every single fire drill that comes up, right? Like I would like to have personnel in those seats to handle those problems that may present themselves. And then I'm there as an outlet if needed, but not required. I want to wear a watch for curiosity only. I don't want any time obligations or deadlines or anything like that. And then finally I can quit anytime.
I love it, man. Why do you think that? Because I love how clear you are in that. What do you think it is that, why do you think it's hard for some people to like define ahead of time what it is they want? Let's start there. Because the next question I want to ask you is like, well, because you told me at the beginning, like you got caught in this trap of chasing more and more and more. Why do you think that is? Why do you think people get caught in that trap?
They measure the gap. Measure the gap, and that always moves. So Paul, at one point, you probably had a goal of making $100,000 a year. Well, you hit that and you probably weren't content, right? 100,000 quickly became 200. When you hit 200, it became $500,000, right? And that goal constantly moves because it's in our nature to push ourselves and to set those goals farther and farther and farther. You also have, social media is more prevalent than ever before. And I think it's great for a lot of reasons. I think it's also counterproductive for a lot of reasons. I think you see people out there doing 10 deals a month and you tell yourself, man, I'm only doing 2 deals a month, right? Yeah. But if you're 2 deals a month, only take 10 to 20 hours a week and you make $40,000 a deal. I mean, ultimately, like you said, it just comes down to closer versus more, but the more is very tempting because you see other people doing it, you measure the gap. And I think that's why people get addicted to doing that.
And we call it the comparison trap in the Whale Club, like the idea of getting caught playing someone else's game. And I think, a lot of people, and myself included, didn't take the time to clearly define exactly what I wanted. These are preferences. This isn't like a right or wrong answer. Some people have more of a preference towards building a massive business in order to make a massive impact on a lot of people's lives. That's a preference, right? Some people want to be able to live this nomad life and travel around the country and not have to wear a watch or worry about checking into different things. That's a completely different goal to solve. But what happens is we get caught in this, but look at this guy, look at this girl, right? And everyone's got these these businesses, but you don't really understand what it is that they're trying to get closer to. Sometimes they don't also realize what they're trying to get closer to. They're also caught in that comparison trap. So where have you seen that show up?
Oh yeah, it's shown up a lot. I mean, one example is, we see it a lot in CG. So like I have a lot of friends who carry an overhead in their business of, $100,000 a month. Some of them are up at $200,000 a month, and they're hitting a 5x ROI on their marketing spend, right? And that's phenomenal. That's absolutely phenomenal. So I went to our first CG conference back in May, and I walked away going, I've got to increase my overhead. So I walked away and I increased my overhead by about $12,000 a month. That very first month, I felt such like an insecurity inside of me. And I was like, it wasn't like a comfortable one. It wasn't like a pushing myself to grow. It was me feeling that I was out of alignment. I realized like that's not what I want, right? Like, okay, maybe I spend my extra $12,000 a month and maybe I do hit that 5x ROI. But if that's causing me to work more and that's causing me to miss my walks with my dog and my wife in the morning, or my lunch with my wife, or dinner, or whatever it might be, maybe it's causing me stress. It's producing more deals than I can handle, that I have the team for, right? Like I realized that it just wasn't a fit. So, I ended up pulling the plug on that. I decreased my marketing spend to something I felt comfortable with. And, it helped me kind of realize who I am, and I don't think there's anything wrong with that. I think you just need to ask yourself those important questions. What am I working toward? And what I'm doing getting me closer to that?
Right. And there's just so many preferences, like you're touching on risk, just risk tolerance in general. And as someone who came from the world of accounting, I'm sure you understand that better than most, right? This tolerance for risk. And so, having that clear, solvable problem, knowing where you're going, it helps you get closer without chasing more. That's the idea. But let's talk about, because I think that's pretty intuitive. A lot of people understand that, and as entrepreneurs, we do this goal setting at the beginning of the year, and we write down all these things that we want. And I recognize that things are going to change over time. Totally fine. Right. We need to understand what our goals are. And that is fairly simple, right? I mean, I shouldn't say simple, but it's like, it can be done. The real challenge becomes when you actually start engaging in business. And then things pop up, right? Now you're in the game, and all of a sudden you have an opportunity to make more money doing this. Or if you're like me, it's like someone approaches you and says, hey, let's start this other business.
Yeah.
And you're like, oh, that sounds like so much fun. I bet we could make a ton of money, and I'd love to work with this person. Let's do it. Right. And so, if you're like me, you just started accumulating all these obligations, and now you're taking on all these different things. And that whole like solvable problem starts to fade a little bit. It gets fuzzier and fuzzier and fuzzier. And you're not really getting closer. You're just chasing more. Have you experienced that before?
Yeah. Actually, one of the biggest challenges I ran into this past year in 2022, came across a phenomenal mobile home park deal, and it was seller financed. But he was requiring $300,000 down. He had to pay off his existing note. Then he needed X amount for, this, that, and the third, but that part's not super important, but he needed $300,000 down. This is like a 60 pad mobile home park, with a phenomenal value add opportunity. So what I would have had to do, I operate off of the philosophy that I don't put my money into my rentals or my portfolio. I put it into the business. So anytime like I need to put money into a property, I typically borrow that money, whether that's refinancing it or going to get private capital. So in this case, I'm looking at raising $300,000 for the down payment, right? You've got closing costs, which are going to be another $20,000. And then for a 60 pad mobile home park, you're looking at a substantial amount of reserves. I mean, probably need every bit of 150 to 200 grand. So I was essentially mentally budgeting raising $600,000 on top of taking on the heavy lift of this value add. There's a lot of tenants that need to be evicted. There's a lot of mobile homes that are in need of rehab. We need to convert these from park-owned homes to tenant-owned homes. It was a lot, right? And at this time, I was focusing on revamping my business, dialing in the lead management process, making sure we're doing what we need to on acquisitions, adopting novation, stuff like that. My plate was just completely full. On top of that, I was getting married. Literally, the closing of this mobile home park was the week of my marriage. So this was probably one of the best deals I've ever come across. And I ultimately decided that I did not have the mental bandwidth, the time, or the energy to be a proper steward of whoever's money I was going to be raising for this deal, nor would I be able to be a principal to operate the value add plan that needed to be implemented for this mobile home park. So I decided to wholesale the thing, and I made a good fee on it. But that's one of those that, like, I can easily look back and just say, what if, like, you sold the best deal you came across. It's a phenomenal investment, but ultimately I think it would have taken me farther away from what I'm trying to achieve. And, I have this success criteria, I have this solvable problem, and the impetus for all that stuff really is my family. So if I'm taking this stuff on amidst my wedding and honeymoon and starting this new life together, it wouldn't make any sense.
I love that. It's such a good example, because there's so many trade-offs other than money, right? We use this acronym that we talk about in the Whale Club called timer. And I actually added an A at the beginning, so I call it a timer. But, the idea with this is to consider the other currencies that we trade. Of course, money is one, right? That's the M, but you have, A timer stands for A, attention, so attention from your kids, attention from your wife, attention from your family, attention through social media, right? That can be measured. Time, you have impact, or the influence you're making on, let's say, your team or your family or your friends or whoever. You have money, you have energy, right? I think I use this example a lot of times it's not that we necessarily want more time. I think we confuse, I want more time. Like in the case of your wedding, right? It's not like you need a 5-week wedding. It's right. That you want your energy to be present, right? During that. For a lot of us, folks that have kids, it's not that they want like to spend all day with their kids. That's kind of what you actually hear, right? They're like, COVID showed us that, right? It's not really that I want more time with my kids. It's that I want to be more present, more energy when I'm with them. And then the last, our reputation or relationships, right? And so we've got to consider trade-offs in these other areas of life, because it's not just about money. And when you err on the side of more money, well, what are the trade-offs that we're not considering here? And I love that you do that so well. You're able to say, well, this mobile home park, although it would make a great addition to my portfolio, it doesn't fit with the preferences that I've laid out for myself. Yeah, if you take this to 10 people, they might be like, you're crazy. Why wouldn't you take that deal down? But that's the risk in seeking consensus from people who don't understand your preferences and what the problem you're actually trying to solve, right?
Yeah. What's funny is that was the biggest hurdle I had to overcome when selling this deal. Anyone I presented it to was like, I just don't get why you're selling it. They couldn't understand. We couldn't understand.
Yeah. Well, and it's just, I maybe we should talk about that for a second. Like the risk of seeking this consensus from somebody that doesn't really have all the information, and at best most people, the common denominator is usually money, right? Mm-hmm. They're like, yeah, but you could make more money if you did this. Why wouldn't you do that? Yeah. And it's not their fault. It's just, I think that a lot of times we're wired that way. Like our human brain is wired towards more. And the most common currency that we all think about is money, so what's your perspective on that idea of seeking consensus really about any decision in your business from someone who's at best going to give you generalized advice, right? I mean, our parents are guilty of that, right? Although they have their preferences for us, right? They have what they want. My son who did all these things, and then he became this, experienced professional, accountant, doctor, lawyer, engineer, whatever. They all a lot of them want that for us, and they have their preferences. But anyways, where else do you see that showing up? This idea of seeking consensus around what should I do in my business?
Yeah, it's something I still struggle with all the time. I talked about that example this past year where I increased my marketing budget. I didn't increase my marketing budget because it's what I thought was best for my business, right? I saw other people in my circle that were doing it and doing it with success. And I was like, well, if they're having success with it, then like I need to adopt that. Like I've got to put it into my business. If I spend this additional 12 grand and and it nets me 48, right? Like why would I not do that? What I failed to ask myself was like, do I want that? Like, do I want the associated, like you said, like, the acronym A timer, right? That's something that needs to be factored into every single decision. So, a lot of last year, even it's something I've improved upon recently, but a lot of last year I fell into groupthink. I fell into consensus. And when I had a difficult situation present itself, I found myself going to people, hey, I'm having trouble with this employee. This is what's going on. Like, what do you think I should do? We're not making enough money. Our margins are pretty good, but we're not grossing enough, right? So how do I gross more? As opposed to looking inward and trying to figure that problem out myself, I found myself going to others and seeing what they're doing and just trusting that what they're doing is going to work. So we see that a lot in CG. You just see that a lot in life in general. Again, like on social media, it's easy to see other people crushing it and think you need to do more and more and more. But I tell you what, man, I think I recently, again, a lot of this is recent, right? I'd say within the last 6 months, I adopted a daily, like a morning meditation, morning journaling, and then I journal again in the evening. And that's given me so much clarity around what I want in life, what I need to center my goals around, what my business needs to look like. And ever since I started doing that, I've just had the clarity that I've never had before.
Well, I'm so glad you say that, because there's like two, I have a coach, his name's Dr. Jeff Spencer. He refers to like two sides of our brain, basically. He calls it the human mindset and the champion's mind. And if you've ever read Thinking Fast and Slow, Daniel Kahneman, he talks about the system 1 brain and the system 2 brain. So the idea is like the system 1 brain, the human mindset, is our like old brain. That's the survival brain. And we have all these instincts towards more because we needed them to survive for a long time, right? Like that's biology. It was given to us. We didn't ask for it, but we have to reconcile with it. And so what happens is the human mindset eats first. It always eats first. And it's going to be there whether you like it or not. And so the people that I've observed that have had success in their life, they have a strong, operating, we call it an operating system. Like you have a system of operating, right? It's your daily meditation. You have certain practices that you've put in place to keep your human mindset from reacting and making decisions based off of emotions, fear, like impulse a lot of times, right? Because again, the human mindset eats first. It's always going to eat first. And if you don't have a way to filter your decisions, the way to reflect and engage and a system more or less to make these decisions, more often than not, your reactions will take over and you'll just start doing things based off of impulse. And we know from experience that our impulses don't always serve us in the modern world, in business, helping us get closer to what we want. So I love that you have basically built your own operating system, right? You've got your way to filter your decisions to help you get closer to things that you want. And it's a daily practice. You can't let the foot off the gas because again, the human mindset is always working. It's always there.
Yeah, absolutely. Absolutely. And, another good example of it that I just thought about is I actually netted more money in 2021 than I did in 2022. But in 2021, I was pretty much the only acquisitions guy. We did I think it was 70 deals in 2021. I counted for 59 of those. I was working every bit of at least 60 hours a week. I mean, 60 was probably a slow week for me. And I was unhappier than it brought me back to kind of like the accounting world. I realized at the end of 2021, I looked back, I was like, I've made more money this year than I've ever made before. In a lot of other people's opinions, I'm extremely successful, but I'm not happy, right? Mm-hmm. Like I'm out here, I'm calling every single seller that enters our system. I'm locking up every single deal. I'm going on every single appointment. I'm selling all of our deals. I don't have an assistant. It was just crazy. So 2022 is when I switched the emphasis from being, having a high paying job, which is, let's just call it what it was. In 2021, it was a high paying job. 2022, I decided now it's time to build a business that suits my lifestyle. And I've still had a lot of bumps and bruises with that. But even though I netted less this year than I did in 2021, I'm so much more excited than I ever have been before. And it's because I'm finally aligned. I'm just such a, Paul, you used this example before, and it's something that sticks in my head all the time. When do you ever hop in the car, open up your GPS, Apple Maps or whatever, and just like say like, let's head west, right? Like without a destination, you have to enter an address. And it's the same thing in life. So today, as opposed to 2021, I have such a vivid vision as to what the future looks like and where I want to go, what that address is that I'm putting into Apple Maps. And, I can see the route to get there, which is just super, super exciting.
That is so cool. It starts with clarity, right? So let's switch gears and let's talk strategy now. Because when you know where you're going, now we can start building in certainty. We can start working out the best, most efficient path to get there with the least amount of risk. And so one of the ways that we talk about this in order to visualize how we approach strategies is through this concept of the barbell. And for those who aren't familiar with this, it's a way to visualize how we want to approach risk, really, right? So if you picture a barbell, most of us have seen that you don't load weight in the middle of the bar. It means we either want to be on one side of the barbell or the other. And so on one side, we talk about reliability, right? What is we refer to this term called macro belief. Most of us are in real estate. We have a long-term macro belief in real estate. We know real estate to be a very reliable source, predictable. Of course, it's not a straight line up and to the right, but it is very predictable relative to the other assets that are there. So, on one side, we want to have reliability. On the other side, we want to look for opportunities where we have asymmetry to the upside, where the upside is really big, but the downside is very low. And we can make these bets as if we're thinking about the barbell. So tell me a little bit about your barbell. And let's start by talking about the reliability side. What does that look like for you in your business?
For me and my business, that's my rentals, right? Those are always going to be there. And I felt like, so in Virginia, the price to rent ratio doesn't make a whole lot of sense. Meaning, for something that rents out for $1,000 a month or whatever it might be, the price is so high that the cash flow is difficult to make sense of. So that's when I started marketing in Central Arkansas, the Little Rock MSA. And what I found there was that the price to rent ratio was much more attractive, right? So like a deal there is almost like a 2% deal, 2% rule, meaning if the property rents out for $1,000 a month, we can pick it up for 20, put 30 into it, be all in at 50, and it rents out for 1,000. Like that's what we're getting in. It's crazy. So that's why I started marketing there. And I figured maybe I forfeit appreciation by getting into Arkansas because in Central Arkansas, the properties simply don't appreciate, but I get the cash flow, which is conducive to the path that I'm trying to head on. And then in Virginia, maybe the cash flow is a lot slimmer, but and maybe there's a barbell within a barbell here, Paul, because a lot of these rentals in Virginia, for example, the cash flow might be slimmer. It's only $200, $250 a month on average. But we see way more appreciation here than we do in Arkansas. So like I said, my portfolio is kind of a mix of the two markets there.
Well, there's absolutely, it's fractal, which means like, as you zoom in, there's barbells within inside of barbells within inside of barbells. And, I love that you mentioned that because I tend to agree. That's absolutely true. If you zoom in on real estate, on the reliable side of the barbell, well, some of them are going to be upside plays and some of them are going to be more reliable plays, right? The idea is we want to get stuff out of the middle, stuff that's like, it could go well, but it could also go really bad. And that's the type of bet that we want to either push it to reliability or we want to find ways to get more upside and reduce the downside. And I love that this is something I struggled with for a really long time. And it's classic human mindset stuff of trying to maximize for everything, like trying to do too many things all at once. And what I mean by that is, in your case, you're trying to optimize for cash flow. That's very different than trying to optimize for cash flow and for appreciation. You can't do both, right? But we want to, and we try to. And a lot of people are sitting here saying, yeah, but I want the best of both worlds. It's like, I get that, but you need to optimize for the most important thing right now. And so we talk about this in the Whale Club all the time, the idea that if you want passive income, there's going to be trade-offs to that. You're going to have to make certain trade-offs in order to optimize for that certain thing, but it's all a preference, right? And it doesn't mean that you can't do one after you've done the other, but I love that you optimize for the most important thing, which is your $20,000 a month in cash flow.
Yeah. Yeah, absolutely.
So you've got, and again, let's talk about reliability in the sense that you're buying these houses with no money down. You're getting the terms that you need directly with the seller. You're not limited by some 10, rental rule and Fannie Mae and all this stuff, right? You've found a strategy that fits exactly with what your solvable problem is. You're picking these things up with, like you said, no money down or none of your money down, probably in most cases. And you're turning that into cash flow. Is there anything else you've got on the reliable side that you would claim to be highly reliable and predictable?
No, I'd say that's it. Really, just the rental portfolio is my reliable side of the barbell. And I mean, we could dissect that. I broke that into a barbell of Virginia versus Arkansas. There's also like different assets within my portfolio that have proven to be part of the, in the middle of the barbell, right? Like I've got a 6-unit apartment building in Arkansas that's, I thought it was a great deal. It spits off great cash flow. That thing's been nothing but a nightmare, just poor tenant class, very high maintenance. And I found that the downside to that is actually really big. Like, I think there's a lot more work there than I thought there was when I bought the thing, right? So that's something that valuable, super, super valuable lesson for me moving forward.
Yeah. Well, the title of this show is called The Investor Frame. The reason I titled it that is because this is part of one of the tools that we talk about in the Certainty Operating System. And let me get the book here, in Dan's book, Rigging the Game. A lot of this stuff comes from this book. And the idea here is that, so the Investor Frame says, knowing what I know now, would I choose to buy that rental property again? Would I choose to opt in to my current situation? You could look at this in terms of like, knowing what I know now, would I hire this employee again? Knowing what I know now, would I buy this rental? Knowing what I know now, if I had, if your business is worth $1 million, let's say, and I handed you $1 million, would you buy your business back? Because if not, then by staying in that investment, it's like continuing to opt in every single day. So this idea of the barbell and this concept of the investor frame is like, we should be always asking ourselves, well, yeah, I get it. When I bought this thing, I had the best of intentions. I thought it was going to be great. But 6 months later, a year later, all it is just a bunch of headaches. There's all sorts of downside. The upside isn't really what I thought it was. So knowing what I know now, would I still choose to buy that investment property? If the answer is no, then I ask myself, okay, well, what needs to change in order to make that so? If I can't make that change, then what we say is recapture and reallocate those resources. Get your money out of it. Put it towards something that actually helps you get closer to what you want, because we don't load weight in the middle of the bar.
Yeah, absolutely. And then, so applying that into practical matters, right? Gonna sell it. And then moving forward, like I was one of those people that, I've bought a lot of properties. I've wholesaled a ton. I've flipped some, and I just have a lot. So I've been through this stuff. I figured if I can walk it, I know the roof looks good, the mechanicals are good, the windows are good. I see the financials, right? Like we're fine. What I didn't realize is I think I need to get an inspection done on every single one of these things. That was a corner that I was cutting for absolutely no reason at all. So I don't buy properties anymore without getting like an actual inspection done. I don't ask the seller to make the repairs or anything like that, but that's information that I need to have moving forward. If I get a $50,000 potential plumbing bill that comes up on the 6-unit apartment building, like that's something I want to know with my eyes open going into it. Right. Mm-hmm. Comes with single families too. I had a really tough lesson with a house built in 1920. I'll never buy a house built before 1950 again. I don't buy 2 bedrooms. I buy 3 bedrooms or more. I don't flip houses with 1 bathroom. I flip houses with 2 bathrooms or more. Right. Unfortunately, I took some bumps and bruises to learn those lessons. But to your point, like now we have this criteria that we can move forward with, and we don't have to face those again, hopefully.
Yeah. I mean, because you're an accountant, I'm sure you did all this with the big four, right? You have these internal controls, these what we call preventive controls. It's like, it's the difference between saying, the difference between preventive and detective is like saying, here's what we're going to do to prevent bad things from happening. Mm-hmm. And then detective would be like, here's what we're going to do to detect when something bad has happened so that we can make a change. Well, obviously it's better to prevent it in the first place, and a lot of times it takes us getting our teeth kicked in to say, okay, here's the rule that we're not going to do this anymore. Right. We're going to make this rule, this preventive control. And, I love that. Again, all this stuff is like natural. You start to figure it out as you do more and more deals and you get better in business. But it sure would be helpful if someone like, could make us aware of this on the front end. Like, hey, here's the rules that you should probably set in place to not make these mistakes. Of course, we don't have that. So we have to sort of engage and make these rules as we go. But that's a sign of, in my opinion, a sign of experience as someone who says, well, here's the things that we're not going to do, versus the person, the inexperienced person who's like, yeah, but we could make so much money if we did this. Yeah, but you're just looking at the upside. You're not considering the downside.
Yeah. Yeah. And it's hard to see the downside until you've been through it. Like sometimes it really is, right? For example, like this was me getting caught up in group consensus thinking, like you and I were talking about earlier, this 6-unit apartment building, everyone's buying apartments right now. This thing is a phenomenal cap rate, like spits off great cash flow. Like I've got to buy this thing. But I didn't factor in is like, I mean, what happens when you're getting calls from the tenants daily? What happens when, your property manager is blowing you up with emails about all these different repairs that need to be done? I'd say I bought the thing really as a product of me just trying to keep up with the Joneses, just getting caught up with the hype of everybody else buying apartment buildings, honestly.
Yeah. So then what is your upside play? What's your play that's like, it doesn't need to go well. We don't need it, but if it does, that's great. And we can use it to really collapse the time it's going to take for you to get what you actually want, right? What does that look like for you?
For me, that's flipping houses. I still don't do that at a large scale, and I really don't intend to. I don't want to create a second job, but what I have set up is, again, I have this criteria in almost every aspect of my life. So I'm not going to take on and some people listening are going to laugh at this, but I won't take on a flip that requires more than $40,000 worth of work. I just won't. Like if there's a lot of foundational work that needs to be done, I'm not going to touch it. If the ARV is over after repair value, if that's over $350,000, I'm not going to take it on. Right. And so my thinking behind this is, well, if I can keep my rehab estimate and actual rehab, $40,000 or below, I can expedite the rehab, meaning like those are very simple jobs that I can get done within 3 weeks time. Very simply. If I can keep the ARV below 350, which is typically your first time home buyer range, those products are still in high demand as long as you deliver a good product. You put out a good rehab at an affordable price point, it's probably going to sell. So now our carrying costs are less of a concern. The unknowns when it comes to the rehab are less of a concern. And then now I'm getting inspections done on everything I'm buying, right? So very rarely are there things that I haven't seen already before, getting into it. But the upside is there. So previously, before I was equipped, I have a phenomenal contractor now, but before that, I wasn't equipped to take these down. So I would typically wholesale them and, it'd make like a decent wholesale fee or whatever. But now by being able to take those down, and especially the ones that fit the buy box that I mentioned, I'm able to capture much larger profits on those. And I didn't really start doing that until this past year, and it helped us out a ton, big time.
It's just a case in point for, instead of, because you're an accountant, you probably do this all very naturally. Like you were trained classically, and this is how accountants think. I know that because my partner, Dan, who told me all this, he's an accountant and he runs one of the top accounting firms in the nation. And what he tells me is, if you just focus on eliminating downside as much as possible, all you're left with is upside, right? And the mistake that a lot of entrepreneurs make is, yeah, but I could make more money if I flipped a house that was, ARV of 500K. And yeah, I could, I know it's a $60,000 rehab, but we can make more money if we did this. It's like, yeah, but you're considering the upside, but you're not considering the downside. And so what you've done is you said, here's my parameters. I'm not going to flip a house that needs more than $40,000 worth of work. Case in point, limiting the downside. I'm not going to flip a house that has an ARV above a certain price point because there's more volatility or whatever your reasons are. Case in point, limiting the downside, right? So this is such it's a hack. It's a hack. Define the things that you're not willing to do. Define the ways that you're going to reduce downside in your operation. That's what we mean when we say upside. I think a lot of people get confused because I say barbells. You got reliability on one side and upside on the other. But it's not just upside. What I mean is asymmetry to the upside, meaning the upside's big, but the downside's low. Most people forget that point. And I say most people, I'm like talking to myself here, Paul, right? Stop chasing upside and start focusing on ways to prevent losing. It's not quite as sexy. It's not quite as fun, but it's the definition of financial certainty, and how you pull risk off the table in these deals is by defining what you won't do up front.
Yeah, absolutely.
Powerful stuff, man. All right. So what is, I say the greatest lesson. It doesn't have to be your greatest lesson. It could be your most memorable or recent lesson that you've learned, but what's a lesson that you'd like to leave the listeners with in terms of business, entrepreneurship? What would you like to leave the listeners with?
For me, it was extreme ownership. I think it's really easy to point fingers in a lot of different aspects of the business. I'll give a couple examples recently that for me have exponentially improved the trajectory of my business. So I implemented a lead management process in my business this year. And what it started with is, my lead managers weren't making enough phone calls. And the reason I knew that is because I was talking to other operators, and their people were making 100, 150 calls a day. And my guys were only making like 40 to 50, right? And it would have been easy for me to take a look at them and say, you're just not doing enough. You're not working hard enough. How are you spending your time? I don't understand. Instead, ask myself, well, what can I do better? Like, what does our phone system look like? Like, can we use a more optimized phone system? Essentially what I did there, right, was I spent 2 days working as a lead manager, and I measured my results. And that allowed me to find the inefficiencies in our process. Paul, our lead managers today average 300 calls a day, right? Wow. So then we got up to 300 calls a day, and now our connection rate with prospects dropped to about 15%. And, I was like, well, what are you guys just, it would have been easy for me to ask, like, are you guys just not calling the right people? Like, I don't understand. Like, I don't get why people aren't picking up the phone, like, and kind of hang my head. What we ended up doing was figuring out like how to get more phone numbers, how to clean those phone numbers, how to register the phone numbers so that we don't have to worry about getting marked as spam or anything like that, right? Our connection rate now is up to 35% across the board. Wow. So out of every 100 calls, 35 people are answering them. And that alone, like those changes for our business has quadrupled the number of appointments that we get, which has increased the number of contracts and increased the number of deals. Another big one was, I had an acquisitions manager that simply wasn't putting in the work. I think he was averaging 3 calls a day or something. And I think it's super, super simple for me to say, well, it's his fault. He wasn't working hard enough, didn't want it, right? That experience, I think I've learned more in this relationship with my acquisition manager than I have in any other part of my business. So I realized, did I set an expectation with him up front? The answer was no. And I'm actually kind of embarrassed to admit this. Didn't set any expectation. Well, what KPIs did he have to hit? I didn't set any for him. I didn't set any expectations. I didn't set any KPIs. I didn't have him come up with his own KPIs, author them. I didn't have any accountability in place. Did we have a weekly check-in or a daily check-in? Anything like if he didn't hit those KPIs, what happens? There was none of that, right? Yeah. What I found was that I was placing trust in other people to work as hard as I would, to do the same thing I would, which is not a logical thing to do. It's just not. So now, lesson learned, we have KPIs in place, right? I just onboarded a new acquisition guy. Here are the daily numbers we need to hit. Here are the weekly numbers we need to hit. Here are the monthly numbers we need to hit. And all those numbers and all those KPIs are based on his goals. They're not based on mine, right? So when I had the onboarding interview with him, the whole thing was about his why. It was about what he's trying to accomplish and what I can do to get him there. And if you want to hit these goals, these are what the numbers break down to. Then the next question comes, and I didn't do this with my other guy, but I did it with this one. If when the inevitable bad week or bad month or bad day happens and we miss the numbers, how would you like me to hold you accountable?
Right? You sound like Ren Bartlett.
That's who I got it from.
Yeah.
It's literally directly from Ren. But dude, I mean, it's made a humongous difference and it makes so much sense. So now I have a daily huddle with this guy and it says, okay, did you hit your metrics? Great. If you didn't, what's going on? How can we improve? How is today going to be different from yesterday? And I don't think I would have achieved any of that, improved at all if I didn't look inward and ask how I could have been better.
Mm-hmm. Well, and I couldn't agree more with that. And it's just a case in point, again, for defining the rules up front and our bias towards, I mean, this shows up for me everywhere in business. You think the solvable problem, the idea around the solvable problem is fractal as well. As you zoom in with your employees, like, did you define up front what their solvable problem is? Because if you haven't, that's where you've got to start, right? We've got to start there. And then we've got to define the rules we're willing to play by, the things that we're not willing to do, the things that we are willing to do, define what it's going to take to get there. In this case, it was setting KPIs. And again, it doesn't matter what area of your business is, or your life or your investments for that matter. This process can be applied to everything, whether it's an employee, extreme ownership, right? Is basically just saying, have you done this process? Have you defined what success looks like? Have you defined the actions that need to take place? Or did you just like skip all that, hire someone and say, yeah, go get me the results that I'm expecting?
Yeah.
Man, I'm resonating with that deeply. And I try to think daily, like, where am I violating this? Because I guarantee you I'm violating it in one way or another right now. And I just don't even realize it. And I think there's the power in a community of people who can point that stuff out. Hey, I don't mean to be like, a pain in your ass here, but you said you wanted this, but this is what I'm seeing, right? What are we going to do about that? And we all need those people to point that out in our life, whether it's, managing employees or having accountability around, hey, I know you said this was your solvable problem, but here's what I'm seeing you taking action on. And it doesn't seem like that's actually getting you closer to the things that you want. Could it be that you're just reacting based on impulse? Crap, maybe I am, right? So, I try to surround myself with people who are willing to poke those sore spots and poke out, those situations where you might be out of alignment between what you say and what you're actually doing. Yeah,
absolutely. I tell you what, man, that colleague or accountability partner, whatever you want to call it, would have saved me a lot of time and sleepless nights back when I was contemplating that decision for the mobile home park. Right. I think having somebody else sit there and just ask me, like, Tyler, would taking down this mobile home park and keeping it get you closer to your success criteria? Clear answer is no. Right. But I spent so much time contemplating, going back and forth, trying to figure out how to keep the thing. Right. It would have saved me so much time, but it's all right.
Mm-hmm. Yep. Well, we all make mistakes, and it's just part of business and part of life, right? Just moving forward. So, thank you so much, man, for coming in. Lastly, I want to leave the listeners with this. I challenge everybody to adopt the investor frame. So knowing what you know now, what Tyler just shared and the conversation that we've had, knowing what you know now, what changes do you need to make in your business? What needs to happen so that you can get closer to the things that you want in life without chasing more and more? This is the question that we should all be asking ourselves. So, Tyler, thanks for coming in, man. It's just a pleasure to hear your story. I'm looking forward to hanging out with you here in Clearwater in a couple weeks, and seeing what you have to present. Because every time you present, it's always an amazing amount of value being given. So,
likewise, and thanks, Paul. Man, this was a blast. Appreciate you having me on here, and looking forward to Clearwater.
Awesome. All right. Well, thanks everybody for tuning in, and go check out the full episode. It'll be out here soon on Apple and Spotify, and we'll see you on the next episode.